are to their friends and clients. Make sure I move ahead here. Okay, great. As Mary Alice said, today's topic are the new Code Section 6055 and 56 reporting rules that are in effect this year under the ACA. I'm going to start off and spend the first 5 or 10 minutes just giving a quick update on some ACA issues and what to expect this year. There'll be some interesting court cases, and there's been some interesting regulatory action at the end of 2014 and early 2015, and so I thought I'd run through that quickly before we jump into the reporting. So the first thing I just wanted to mention, kind of just an interesting topic and something to keep in mind when you think about how the administration is going to proceed with the implementation of the ACA this year. They're currently down 2-1 in Supreme Court decisions. If you may remember, when they were arguing over whether the Act itself was constitutional and whether the Medicaid expansion provision was constitutional, the Supreme Court split on those issues. And then again in June of 2014, the Supreme Court held against the administration in the Hobby Lobby case and basically said that the government could have used less restrictive means when dealing with for-profit employers who have a religious objection to offering certain forms of contraceptives. They had identified an alternative method for complying for nonprofit religious institutions, and the court said that they should be able to extend that to certain closely held for-profit institutions. And so in 2015, this may get in front of the Supreme Court again in terms of determining whether the opt-out itself is the least restrictive alternative. There are 2 cases, the Little Sisters of the Poor and the Priest for Life case. In each of those cases, the petitioner essentially is challenging the government's alternative, and basically under the alternative, rather than having to provide the contraceptive coverage, you have to fill out a form and send it in to the government or your carrier, and then they are able to administer the benefit and provide the contraceptive care to the participants who also have a right to it under federal law. And the issue comes in with the form. The form actually requires the entity to disclose its TPA or its insurance carrier, and so the Little Sisters and the Priests for Life, they're basically saying, well, if we have to inform the government as to who our carrier is, then we're basically, enabling the provision of the care that we objected to, and so they're challenging whether that alternative is the least restrictive. It's hard to handicap this one. I don't think these claims are going to in the day. I think that the alternative is fairly light, but we may see this again in front of the court this year. One case that we're definitely going to see, and we're going to have oral arguments in early March with a decision in June on this, and this is the, well, in a way it's one of the last major challenges to the ACA here, and that's the King versus Burwell case. And the issue here is whether the Affordable Care Act provides for subsidies for coverage in the exchanges in states with a federal exchange, or is it limited to states with only a state exchange. And if you take a kind of a closed reading of the law, you can definitely find a section that says that the subsidies are available for coverage purchased through a state exchange. In the context of the law, pretty clear that the subsidy should be available to all Americans regardless of the state in which they live, but this is a major challenge to the Act. It would have a pretty major effect on insurance markets across the country, obviously particularly in those states with the federal exchanges. I think there are at least 35 or 36 states that have the federal exchanges. This case probably can go either way. Earlier in the year, we were wondering if the administration would really want a chance going down 3-1 in front of the Supreme Court. We thought they might work with Congress to fashion some sort of a legislative fix where perhaps the the administration gives a little bit on issues that both sides to raise questions with, like the Cadillac tax, the medical device tax, the 30-hour work week, moving that to 40 hours. They're having some kind of a fix there, and then the other side would give on the subsidies, and they could affect a legislative fix to clear up the language and then take care of some of those other provisions. That does not look like it's going to happen, and so oral arguments on King versus Burwell will be held in March, and we'll see a decision in June. Something we've been working closely with Sterling is on the wellness issue. For years, wellness has been a critical component of the ACA. It's something that is supported in general by the current administration. However, and the DOL has said for years that employers can require employees to use health risk assessments or take health risk assessments to get on the plan as long as they're not results-oriented. The EEOC has a different take here. The EEOC basically sees a mandatory health risk assessment as a per se violation of the ACA, or sorry, the ADA, the Americans with Disabilities Act. The EEOC filed no fewer than 3 lawsuits back in the third and fourth quarter of 2014. Those are making their way through the courts, and the question will be whether 2015 will see more lawsuits here on this issue. We're hoping that the only other case out there that has gone through at least a couple of courts, including an appeals court, is this, that will be instructive, and that's the Seth versus Broward County case, where Broward County here was the employer, Seth was the employee, and the county was penalizing employees $20 a paycheck if they didn't fill out the health risk assessment. The lower court and the appeals court held for the county. They said the wellness program was an important integral part of the group health plan, and so it fell within an exception to the ADA. And it was an interesting decision, a bit results-oriented, but it would be great for employers if other courts felt the same. One other recent development towards the end of last year, the federal regulators released the number 22 in their FAQ series on ACA implementation issues, and they just reiterated a couple of earlier points that they had attempted to make clear in prior guidance. One of them is that employers really cannot pay for individual health insurance policies, either on a pre-tax or an after-tax basis. And the other FAQ piece in this, or the other question in this FAQ piece, focused around a tactic, not that we're seeing so much in New York, but it's out there, and it's where a vendor approaches an employer and has a strategy to get the high-risk claimants off of the plan and onto the exchange plan. It works, you know, if you're self-insured, you could see where that would be a very interesting strategy to lower some claims experience. And they said that that would be a violation of ERISA, HIPAA's non-discrimination rules, and it would be essentially strictly prohibited to do for active employees. The impact is a little bit greater. They kind of implied here that there's a possibility that when you offer employees cash in lieu of benefits, like if you offer a basic opt-out benefit, which is permissible as long as you're not targeting it towards high-cost claimants, that if you do that, the amount of the opt-out might need to be considered an employee contribution. In other words, if you're charging employees $100 per month for your insurance, but you pay them an additional $50 if they opt out, there's a question as to whether, for affordability purposes, your cost is $100 to the employee or whether it's $150 because he needs to, or the company, sure, he needs to give up the $50 in order to be able to purchase the insurance for $100. So it's really a $150 swing for the employee. The IRS has implied that that's the case, but they haven't really come out and said it yet. So we'll be waiting to hear a little more about that. One last word on wellness programs. For affordability purposes, you get to treat all of your employees as non-smokers. If you have a bona fide wellness program where you charge tobacco users, say, $150 a month, and non-smokers get charged $100 a month, then you get to pick, or you get to consider $100 as the required employee contribution for affordability purposes, even if some employees are smokers and pay $150 per month. Now, of course, this must be done within the confines of a HIPAA and ACA compliant wellness program. Okay. So that's our quick update on some hot topic ACA issues. Now I want to get into the bulk of today's webinar, which is the employer and provider reporting requirements. And really, before I get into the nuts and bolts of the reporting, I wanted to spend another couple of minutes talking about an issue that we've heard about from many of our clients around the country, and it involves the forms, even though the forms are not required to be provided until next year. And so we've heard that some tax preparers are asking employees for their 1095 forms in order to prepare their 2014 taxes. I think there was a meeting of CPAs somewhere where they may not have gotten the message that these requirements have been delayed until 2015, with really the first reporting is going to be occurring in 2016. So bottom line is that employers are not required to provide a Form 1095-C to employees for 2014. And likewise, carriers are not required to provide the 1095-B for 2014. These two forms are not necessary to prepare an individual's tax return for 2014. The form that folks will get for 2014 tax purposes is the Form 1095-A. That's the marketplace form if you had coverage through a marketplace, and individuals will use that form to reconcile their premium tax credits. Okay. The way it's going to work for 2014 is that taxpayers are going to either, well, they'll check a box. It'll be line 61 on Form 1040, line 11 on the 1040 EZ, indicating that they had coverage for the entire year. And now if you didn't have coverage for the entire 2014 calendar year, there are instructions for that line 61, and it directs you to Form 8965. And 8965 is the form that's used to report a coverage exemption. And so if you don't have a coverage exemption and you and your dependents did not have coverage for certain months, or really you get a 3-month window of not having coverage, but if there's a substantial period of time during which you don't have coverage, then you may, that Form 8965 will give you the information you need to calculate your penalty under the individual mandate. Okay, so again, now we're in the bulk of what we wanted to cover today, and these are the new provider and employer reporting rules under the ACA. So the Affordable Care Act, and actually before I get in, just want to update folks, we actually just received final forms and final instructions on Monday. And so you guys are basically probably the first to hear a webinar on these new final forms, and there were some changes, or at least some clarifications, between the draft forms and the final forms. And so we have links to all of those final forms later on in the presentation, which you'll all get a copy of later, but the final forms are now available. So the Affordable Care Act added 2 new sections to the Internal Revenue Code with regard to reporting. There's Section 6055 and Section 6056. Section 6055 is for providers of health insurance, and so that includes health insurance carriers, self-insured plans, multi-employer plans, and governmental plans, the providers of the insurance. If you are fully insured, then you don't have an obligation under 6055 as an employer. The carrier will take care of your 6055 obligation. The other one, 6056, is a little different, whereas 6055 is for providers of insurance. 6056 is simply applicable to what the government calls applicable large employers. Those are generally employers that are subject to the pay-or-play mandate. And as I mentioned below at the bottom of the screen there, even if you are exempt from the pay-or-play mandate in 2015 because you're in that sweet spot of having 50 to 99 full-time equivalents, you still have a reporting obligation in 2015. So if you have 50 or more full-time equivalent employees on average in 2014, then you have a Section 6056 reporting requirement this year. The rules were originally intended to be effective in 2014. However, compliance is voluntary until 2015, and the first mandatory reporting will be in January and February of 2016, reflecting the 2015 calendar year. As we get into the nuts and bolts here of the reporting, you'll see that it is fairly complex and granular. There are indicator codes to denote various aspects of the reporting and to whom coverage is offered and how much it costs and when do they have it and when do they not have it. There is a little bit of relief from the reporting if you make what they call a highly affordable offer of coverage to employees and to spouses and to children. You'll have, and we'll talk a little bit about that. And again, even if you're not subject to the employer mandate in 2015 because you have 50 to 99 FTEs, you do still have a reporting requirement. So again, the 6055 is applicable to the providers, and 6056 applies to the large employers. And then just as a reminder, to determine if you're an applicable large employer, those are employers that had at least 50 full-time equivalents on average in the prior calendar year, and that's using a 30-hour per week average or 130 hours per month, which is the equivalent of 30 hours per week. So when we talk about who we need to report on, for purposes of Section 6056, if you're a large employer, you're reporting on your full-time employees. And this is true whether you offer a plan, don't offer a plan, have a fully insured plan, have a self-insured plan, you're reporting full-time employees. If you're self-insured, it gets a little more expansive, and you are reporting not only your full-time employees, but you're reporting on any covered employees for purposes of Section 6055. And we find that a lot of larger employers that are self-insured, they may tend to offer coverage to even to part-time folks. We have some clients that offer coverage if you're working 20 or 25 hours, and in that case, when you have these part-time employees who elect coverage under a self-insured plan, they're now going to be reported under Code Section 6055. So a little more detail on the 55 reporting, and we're really not going to concentrate too much on this reporting. We're really going to focus more on the employer reporting, but it's important to mention this because if you're self-insured, then you have an obligation under this section as well. So the 55 reporting, again, it's for the providers of health insurance, so insurance companies, self-insured plans, multi-employer plans, governmental plans. Those are examples of entities that will have a 6055 obligation. This reporting is used by the government to track compliance with the individual plan. And It includes self-insured plans. The reporting applies to self-insured plans. But if you are an applicable large employer, which most self-insured plans are sponsored by large employers, you're going to use the 1094 and 1095-C, as in Charlie, forms. The -B as in boy forms are used essentially mostly by the insurance companies. From an employer standpoint, the only time you're going to use the 1094 and 1095-B forms are if you're self-insured and you have fewer than 50 full-time equivalents, and that is pretty rare. One thing that the final forms clarified is that even when you're a large employer, if you're self-insured, you may need to report, or you will need to report, on anyone who's covered under the plan. And some companies extend coverage to non-employee directors. Some will have retiree coverage. COBRA participants in the year after they terminate. These folks are not employees, and so they're not required to get the -C forms. And so even if you're large, if you cover folks like non-employee directors, retirees, COBRA participants in the year after they terminate coverage, then you can use the -B forms to report for them, or you can use the -C forms. You have a choice there. So a little bit of relief there. The -B forms are actually much more simple than the -C forms, and we're going to take a look at them in a second here. And so again, we do have final forms out now. There are the links to follow for those forms and the instructions. They're available on the IRS website. Section 6056 reporting, again, is for the applicable large employers, and this is used by the government to track compliance with the employer mandate and to determine individuals' eligibility for the premium tax credits. We also have final C forms available now. They were released on Monday. If you're fully insured, you're only completing parts 1 and 2 of the form. If you're self-insured, you complete parts 1, 2, and 3. And we're going to take a look at what these forms look like in a second. Electronic delivery is permissible if you get consent from the employee. You do need to get consent for that. The consent can be provided electronically, but you do need the employee's consent to make that delivery.
Oh, freaking A.
So this is what the 1094-B form looks like. This is the transmittal. The 1094 forms, the 1094-B and the 1094-C, an easy way to kind of think about what these forms are for, think of them like a cover page to a fax. And the body of the fax are all of the 1095 forms, whether it's the 1095-B or the 1095-C. Those are all the forms that go to the employees, and this is like the summary, basically. And so here it's pretty simple. This is what the carriers are going to use by and large. Filer's name, EINs, and then line 9 here, the total number of -B forms, the 1095-B forms, submitted with the transmittal. This one, pretty simple. This is the 1095-B. This is, again, the one that, by and large, will be completed by the insurance companies. Basically gives out pertinent information on the carrier, the individual, if there's an employer involved. And then Part 4 just lists the covered individuals, puts their socials, their date of birth if the social is not available, and then their months of coverage, whether it was the entire year or just certain months of the year. And again, these are the -B forms. These are the ones that are going to be used primarily by insurance companies.
I have to imagine they can say see attached report and like pump out an electronic version.
So this form is what the employers are going to be using. This is the 1094-C form. This is the transmittal. Again, this is kind of the cover page to all of the 1095-Cs that will be given out to your employees. Part 1, it's all information that you're going to be well aware of. It's your permanent employer information. In line 18, you disclose the total number of 1095-C forms. And then we get into a little bit of the details here. And the line 19 asks, is this the authoritative transmittal for this ALE member? And so let me talk a little bit about how this all works kind of from a company standpoint. As you may know, the employer mandate, when you're trying to decide if you're a large employer, if you're over 50 or not, or this year if you're over 100 employees, you've been told that you need to look at all of the employees within your controlled group, your tax-controlled group, to see if you exceed that threshold. So you have 4 commonly owned companies, and each of them have 30 employees, then you have 120 total, and so you would be an applicable large employer. Now, even though you add all the employees together to see if you're a large employer, the penalties and the reporting all apply on a per tax ID basis. So taking my example of the 4 employers with 30 employees each, companies A, B, C, and D, if companies A, B, and C offer insurance and company D does not offer insurance, then company D is the only one that would be subject to penalties in that example. The fact that one member of your controlled group doesn't offer coverage, it doesn't taint the other members, and it won't trigger a penalty on the other members. And so each member of the controlled group, each company with its own tax ID, will have one authoritative transmittal. You don't have to aggregate all of the members of your controlled group and have someone from the controlled group do an authoritative transmittal. There will be one authoritative transmittal for each applicable large employer member, and they call them ALE member. An ALE member is one member of a larger applicable large employer controlled group. Most companies are going to have one 1094-C, and it will be the authoritative transmittal. As an example of a situation where a company might have multiple 1094-Cs and then therefore have to pick one of them as being the authoritative transmittal, might be if you have a number of separate divisions all rolled up under one tax ID, and maybe one division has one payroll company and another division has another payroll company, and they're each going to develop their own separate 1094-Cs. And then if so, one of them will have to note that their particular transmittal is the authoritative one for that applicable large employer member. I think in very large part, most companies, though, will have one of these forms, and it will be the authoritative transmittal. Line 20 is just disclosing the number of 1095-Cs that are filed by that ALE member, and then line 21 is disclosing whether the ALE member is part of a larger tax-controlled group. And then if yes, you go on to part 4, and we show that in a couple of pages. Line 22, again, is going to be a little more granular, and there you will check any or all of those boxes as applicable, whether you've made a qualifying offer, which we'll talk about in a few minutes, whether you're certifying that you are making a qualifying offer, but it's not quite a qualifying offer, but it falls within the transition relief for this year, whether you have other transition relief under the pay or play mandate, like you're in that 50 to 99 group, you have a non-calendar year plan, it's your first year in existence. There are all several different types of transition relief. If you're not offering dependent coverage yet, and that would be disclosed in that box C. Box D is the 98% offer method. We'll talk a bit about that in a few minutes.
Have to, because we're not accountants. We're not allowed to give tax advice. So why are we? expected to know.
Part 3 is the applicable large employer information that you're going to put in by month. And basically this will be an indicator as to whether you've offered minimum essential coverage for the entire year or just for a number of certain months. And then columns B and C will be, I think there's some folks that might be unmuted that we can hear. Let's see. Column B is, again, just the employee count. You're going to disclose the number of your full-time employees. Column C is the total number of employees.
Hey, Stacy, give me 1 second. I'm going to mute everybody and unmute you.
Okay.
Okay, you're back on.
All right, I think we're live. And then column E is another spot to include different indicator codes to denote that you're eligible for transition relief and exactly what transition relief you're claiming. Again, is it because you have a non-calendar year plan or you're a smaller applicable large employer? All of that information is disclosed in the instructions. And then part 4 is the spot where you will list all of the other entities that are members of your tax-controlled group or who were members at any time during the year. So another takeaway is that you will need to make sure you know which entities are within your tax-controlled group. So this is a big one. This is the one that you've been hearing about for the most part, and that's the 1095-C. This is the form that, as an employer, you'll need to give one of these to any employee who is required to be treated as a full-time employee in any month of the year. You see part 1 and 2 are the parts that you will complete if you have a fully insured plan or you offer no coverage at all. In part 3, you will not complete if you're fully insured, but if you're self-insured, then you complete part 3 because that will take care of your section 6055 reporting. Part 3 is where you disclose all of the covered individuals, the employees and their covered dependents, their socials, and if their socials are not available, then you can report their date of birth. In one word about the socials, there's some guidance in the preamble to the regulations that talk about making an attempt, at least a few attempts, to get the Social Security numbers of your employees' dependents. Basically, if you make an attempt when they first come onto the plan to get the social, that counts as one attempt, and you're supposed to make another attempt at the end of the year and then at the end of the following year. And if you're still rebuffed and you're not provided with the date of birth, Social Security number, then you can use a date of birth in lieu of the Social Security number. But they do want you to make a couple of attempts at getting those socials if you have a self-insured plan and you're therefore reporting under Part 3. So Part 1 at the top, employee information, and then on the right is the employer information. And really lines 14, 15, and 16 are where you're going to disclose all of the pertinent information. Line 14 discloses the offers of coverage, and there are maybe a dozen or so or 10 or so what they call indicator codes to report on the type of coverage that's offered. Was it minimum essential coverage? To whom was it offered? Why wasn't it offered? Was the person not a full-time employee? Did he terminate? Is he in an initial measurement period? Is he in a waiting period? That's in line 14. Line 15 is the cost. You're reporting there the employee's contribution that he has to make for the lowest cost plan that you offer that provides minimum value coverage. And then line 16 is whether or not you qualify for any of the affordability safe harbors. And you'll disclose that information there, like whether you have the W-2 safe harbor or the rate of pay safe harbor or the federal poverty level safe harbor, or if the employee just enrolled in the plan. If you offer unaffordable coverage, but the employee decides to enroll in the plan anyway, that's essentially a safe harbor because he can no longer obtain a premium credit because he now has coverage. He chose to enroll even though it might have exceeded a little, 9.5% of his household income. He might have felt it's still a good deal, and so he's going to take the coverage, and therefore the employer will not be penalized with regard to that employee. So that's the 1095-C form. The general reporting here is basically you're doing this for all full-time employees, and you're reporting the information on a monthly basis. Like I said, the lowest cost monthly premium for self-only coverage, to whom this coverage offered, whether it provided minimum value, and then the indicator codes may be used to report other information. If you are pulling together 250 or more of the 1095-Cs, then you must file them electronically along with the Form 1094-C, that cover form. So again, remember, with regard to being a large employer, at the very least, even if you're fully insured or self-insured or offer nothing at all, you have to report certain information: your employer contact info, the calendar year, whether you provide minimum essential coverage and to whom, the months you provided that coverage, cost, the number of full-time employees for each month. And this is just kind of a sampling of the information you'll need to pull together to populate these forms. They're not super difficult it's not impossible to figure out the indicator codes. It may be possible for employers to do this on their own, but you've got to consider your own payroll system and your time and attendance system and your benefit system and how to pull the information you need to populate these forms. So one thing that the final forms and instructions clarified was that you don't need to report on an individual who is not a full-time employee at any point in the year. So, someone who's not an employee or who is in what they call a limited non-assessment period, an LNAP, you don't have to report on them if they're in that for the entire year or they're not an employee. So, if someone is in an initial measurement period for the entire year, entire calendar year, then you won't have to report on them for that year. Or if someone is in a waiting period and they're working full-time in the waiting period, but they terminate before the end of the waiting period, then they will never have gotten out of their limited non-assessment period. They'll never have been required to be treated as a full-time employee. So even if they worked full-time during their waiting period and then they quit, you wouldn't have to provide them a 1095-C. That was at least unclear based on the draft forms. Now, just to clarify, obviously, when we're filling out the 1094-C, when we looked at Part 3, Column C, they're asking for all of the employees. So we just run back there real quick. Column B is the full-time employee count. Column C is the total employee count for that ALE member. And so these folks, even though they're in a limited non-assessment period, they're still an employee, and so they will be included in the total employee count that's reported on that 1094-C, but then you're just adding them into the count. You're not giving them their own 1095-C form. So nice little bit of relief there. Another issue that was, pardon me, that was clarified in the final forms, and I mentioned this earlier, so, and this really is more applicable to self-insured plans, but if you have non-employees, like non-employee directors or retirees after the year of retirement, or employees on COBRA, former employees on COBRA, then you have a 60-55 obligation, and so you can either use the -B forms if you would like. You could also use the -C forms, but the B forms are very simple. You can use the -B forms to report coverage for those individuals and their covered family members. Under the draft instructions, it was just kind of unsaid and it wasn't clear at all. We assumed that you needed to use the -B forms, but luckily under the final instructions, they clarified it's really the employer's choice. You can use the -B or the -C forms for these folks. And again, this is only applicable to you as an employer if you're self-insured. So one of the indicator codes that you will use to report on the coverage offered is whether you made an offer of coverage to a spouse. And so there were questions raised. The employer said, well, what if I only offer coverage to spouses who don't have or aren't eligible for coverage under their employer's plan? We have a spousal carve-out where you don't get to come on our plan if you have your own offer of coverage to your own employer's plan. And they said, as long as it's a reasonable objective condition, then you can report as having offered spousal coverage, even though they can't get it unless they don't have coverage elsewhere. And that's fine. So as an example, like I said, if you only make an offer of coverage to the spouse, if the spouse certifies that they don't have access to other coverage from another source, then you can still treat that as having made an offer of coverage to the spouse for reporting purposes. Okay, so now it might get a little bit dry, so I apologize. I want to spend a few minutes on what the IRS has done to simplify all of this for you. The earlier forms and well, not even the forms, really the regulations themselves were criticized as being a little overly complex. And so when the IRS released their forms back in 2014, they identified a couple of simplified methods of reporting. I'm just going to run through them relatively quickly and really just so you'll see that they are not super simple and they won't apply to many employers. But let's just run through them quickly anyway. So as you may know, under the employer mandate, you're only required to offer coverage to full-time employees and their dependent children. You're not required to make an offer of coverage to a spouse. However, if you make what they call a qualifying offer, you are only required to report names, addresses, and tax IDs for employees who receive a qualifying offer. And so what is a qualifying offer? Well, it's an offer of minimum value coverage to the employee that is highly affordable to the employee, meaning that you have to be able to qualify under the federal poverty level safe harbor in order to have made a qualifying offer. So in other words, the annual cost of coverage, of single coverage to the employee, can be no more than about $1,100, because that's basically equivalent to 9.5% of the federal poverty level. The offer also must include an offer of coverage to the spouse and the children. It doesn't have to be highly affordable. In fact, you can make the spouse and the children buy up and pay essentially the full cost of coverage, but you have to at least have made an offer of minimum essential coverage to the spouse and the children to have made what they call a qualifying offer. And again, if you made a qualifying offer, you only need to report a minimal amount of information, and there's also a simplified reporting statement you can give to employees instead of the 1095-C. But again, I think this will probably only apply to a subset of employers. So if you make a qualifying offer to an employee for the entire calendar year, then your reporting for that employee can be simplified. There's a little indicator code to show that you've made a qualifying offer of coverage, and then an employee that has received a qualifying offer can either be provided with the 1095-C, or the employer can give an alternative statement, basically just informing them that their family is not eligible for a premium credit that year. And so this, to employers that qualify, this could be pretty nice because it lets you create a uniform statement to give to everyone that you don't have to tailor it to each individual employee. Unfortunately, this alternative statement, the form or the statement in lieu of the 1095-C, it's simply not available if you're self-insured or employees covered under a self-insured plan, or employees that did not receive a qualifying offer for the entire year. So, while there's the availability of this alternative statement, for several reasons, it may be difficult really to qualify for it. And then at the end of the day, even if you use the alternative statement for the employee, you still have to provide a 1095-C to the IRS. So you're still going to be preparing the 1095-C regardless. Even if you don't make a qualifying offer for the entire year, you can still mark the box in the months for which you did make a qualifying offer. And then there's a little bit of transition relief in 2015 for employers that made a qualifying offer to at least 95% of their employees. They can use the alternative statement method for all employees, even those who did not receive a qualifying offer, and that statement will just simply indicate a couple of additional items of information. It'll indicate that if you didn't receive a qualifying offer or you received no offer at all, that you may still be entitled to premium tax credits, and a statement that the employee should see IRS Publication 974 for more information regarding their eligibility for a premium tax credit. So that was pretty simple, right? This is the second simplified method. This one I think will apply to even a smaller subset of employers, but the folks that it does apply to, it will be pretty useful. And this can apply separately or in addition to the simplified method number one. And this basically says, look, if you provide affordable minimum value coverage to at least 98% of your employees and their dependent children, then you can certify that you've made an offer of coverage without having to identify which employees are full-time. And so this is very useful if the employer doesn't want to determine and report on who is full-time versus part-time. So when would this be useful, and really to whom would it apply? From what I can tell, thinking it through, I think this would really only be useful for your self-insured plans that offer coverage to part-time and full-time employees. So, for example, we have some clients that are very paternalistic, and if you come to work for them, you're going to be offered coverage under their self-insured plan. Whether you're full-time or part-time, you work 20 hours a week, it doesn't matter to them, they're going to offer you coverage. In those cases, as an employer, they don't really care whether the employees work full-time or part-time. They don't track it because it simply doesn't matter to them because they're not using it for eligibility purposes. And so this allows them, pardon me, to complete their reporting without having then to separately determine which employees are full-time and which employees are part-time. So all of the regular reporting still applies. You just don't have to denote which employees are full-time and which employees are part-time. So I'm going to wrap it up with a couple of more slides on a little more of the minutia, and then we'll open it up for questions. So multi-employer plans, these are plans that are maintained pursuant to a collective bargaining agreement, not MIWAs, not multiple employer welfare arrangements, but multi-employer plans, your union plans that are offered to your represented employees. The funds, the multi-employer plans, They can facilitate the filing and the furnishing of the reports for employers, but they're probably not going to be doing that for the most part. And still the liability for the employer reporting, the Section 6056 reporting, and the penalties are not transferred to the multi-employer plan. The employer ultimately has the obligation to complete those reports. So what the multi-employer plan is going to do is they're going to have the obligation to send out the 1095-B, and the employer will still complete a 1095-C for its unionized employees. There is a little bit of help here, though, because an employer doesn't always have optics into the multi-employer plan. There are special indicator codes to use. The employer can claim that is making an offer of coverage as long as the employer is required to do a couple of things. It has to be required to make contributions for that employee pursuant to a collective bargaining agreement. And as long as the union's plan offers coverage to employees who satisfy the eligibility conditions, and that coverage is affordable and minimum value, and it offers coverage to the dependent children as required by the ACA. There's a little bit of transition relief there. But this is basically all the employer needs to confirm in order to indicate and complete their 1095-C on behalf of their union employees. They won't need to report the same level of information that they'll need to report for non-union employees. So probably the most important slide of the day is this one here. This is our last slide. And it is regarding the penalty relief for 2015. And the IRS has said that as long as you've made a good faith effort to perform your requirements under Section 6056, you will not be liable for any accuracy-related penalties. So you still need to make sure that you're performing the reporting in a timely manner and you're making a good faith effort, but don't get too overly hung up on which code is which. I mean, you should obviously try to get it right, but a lot of them kind of look very similar. Sometimes it's not clear which one to use when there's multiple codes that apply. They do try to suss that out in the instructions, but again, just make sure you make a good faith effort, and you should not be subject to any penalties for accuracy-related errors. Please feel free to join our ERISA blog. We put out timely blogs on these and other issues. And we have the latest edition of our healthcare reform book, a very robust Q&A book that we provide through our partners at Thompson. And there's a 20% discount through this link. That ends my prepared slides for today. Maybe we could just go back in case folks want to look at that last slide, and I can open it up to questions. I can see a few questions have come into me, so maybe I'll start there, and then Mary Alice, if more have come into you, then you can read them out. But I think I only see one here, so let me address that one first. The first question is, we consider full-time employees to be those who work 20 or more hours, and we offer coverage to them. Do we include them in our reporting? Question on the way. Do we include them in our reporting our non-calendar year? When do we need to file our reports? Okay, so it's a great question. You offer coverage to your full-time and part-time employees, and you've asked, do we include them in our reporting? If you're self-insured, then yes, you have to report on all of your coverage. So any of your part-time employees.
15, and what do we? Yes.
Then you do report even your covered part-time employees if you're self-insured. If you're
Okay, let me. Okay. Dictate what you want me to say.
if you're fully insured,
Renewed December 1st.
then you only need to report full-time employees.
Oh,
Even if you're non-calendar year, the reporting is always performed on a calendar year basis. So there are some codes to use if you have transition relief, like if you say you have until July 1st of 2015 to comply with the pay or claim mandate, you'll let them know you didn't have to comply for January through June, that the reporting will always be based on a calendar year. And the reports are due basically in the first quarter of the following year. January, the employee statements are due, the statements to the IRS are due in February or March, depending on whether you are filing electronically. Okay. The next question is, can we get a copy of the PowerPoint? And I believe your contact at Sterling will send out a copy after the session today. Other questions, how are not-for-profits that don't file tax returns affected? There's no blanket exception here for nonprofits. They'll still need to perform this reporting as applicable. The next question, again, is on the due dates for the reporting and how does it affect the plan that's non-calendar year. And again, the reporting is all done on a calendar year basis regardless of your plan year. And it's due in the first quarter of 2016, representing the 2015 calendar year. Mary Alice, I don't know if any other questions have come in to you. Those are the ones that have shown up in my chat box.
Stacy, no, we're getting the same questions you are.
Okay, great. Well, wonderful. So it looks like everyone has asked their questions. If you have further questions, please follow up with your benefit consultant at Sterling who invited you today. I want to thank all of you for attending, and I look forward to speaking with you on a future webinar. Hope you have a great day.
Thanks, Stacy.
Thanks. Take care, everyone.
You too.